A lot of people are talking about what's going to happen to house prices as we come out of lockdown, and some people claim to know exactly what's going to happen. But in this video, we'll look at the many market drivers which influence house prices using the latest data. Now, if you want to keep abreast of these factors, why not sign up for our free weekly market roundup? There'll be a link above, and the link will also be in the description below. And why not tell us what you think is going to happen in the comments below? So let's look at that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Let's begin by looking at the factors which drive house prices. Because we generally buy houses with mortgages, when interest rates are low, that tends to push up house prices. Another factor is the increasing demand for houses. That might just be because the population's increasing, or it might be because households are growing smaller, with less people per household. And because buying a house is a very large investment, wage growth is very important. When wages are growing rapidly, that tends to be good for house prices. But there are also factors which drive house prices down, and that might be because housing supply increases as more houses are built, or it could be because inflation is high. Because when the price of goods and services that you buy every day increases, that leaves you with less disposable income, which you can spend on your mortgage. And if house prices are simply too high, then that reduces the number of people who can afford to buy those houses. And that tends to be a drag on house prices. So in the rest of this video, we'll go through each of those factors and some others to see where we stand at the moment. So now let's look at the UK housing market in June 2020. The latest UK house price index was published in March 2020, and it actually showed a slight uptick in house prices. But house prices peaked in the latter half of 2019, and the small increase we saw in March was insufficient to reach that peak again. Then in April, Nationwide published its monthly house price index, which showed that the fairly brisk price increase in March, which was 3.7% year on year, decelerated quite sharply to an annual growth of 1.8%. One difficulty at the moment is that there are simply less sales and purchases. HM Revenue and Customs publishes statistics on how many transactions happen per month. And in April last year, for example, there were about 100,000 transactions in that month, whereas this April we only saw about half as many transactions. In fact, the transaction rate was so low that the ONS has temporarily suspended publishing the UK house price index, presumably until statistics become more reliable as the number of transactions increase. Probably the most important factor driving house prices is the rate of economic growth and the number of people who are employed. The black line that you can see here is economic growth in the UK. Notice how sometimes it dips below zero, and that's called a recession. The blue bars indicate periods where the house price growth was positive, and red bars indicate when house prices fell. Notice how during a recession, that tends to be when house prices fall, and the longer and deeper the recession, the greater the size of the price fall. You can see 4 recessions here, with the most recent being the global financial crisis in 2008 and 2009. The fact is that we're probably already in a recession, and according to the Bank of England, the cumulative loss in growth will probably last for some time. The greatest impact will be in year 1 in 2020, but there'll also be a limited drag in year 2 and in year 3, and this is due to lower confidence and higher uncertainty, which may take some time to disappear. Their expectation for unemployment is that it's going to peak at just under 10%, and then unemployment will fall quite rapidly as we enter 2022. Another organisation that produces forecasts for the UK is the National Institute for Economic and Social Research, or NISA, and in this May report they produced a forecast for UK GDP. They expect a 7% contraction in 2020 and then a 7% rebound in 2021. If we go back to that graph from Nationwide, a 7% fall would be about here, and that's considerably bigger than the fall we saw in the global financial crisis, when house prices fell by around 15%. Then we may see house price falls which are even bigger than we saw in 2008. The authors say that there are huge risks around the forecast. That's why they have these huge error bars around the central case, which is the black line, with a greater probability of things being worse than being better than that central case. And there are a number of reasons why that might be the case. The virus may become more virulent through mutation. We may have secondary waves of infection, which would extend the lockdown period and the economic damage. And there could be long-term damage to the economy, which lasts long after the lockdowns end. It may be that supportive policy measures are withdrawn too soon, which could increase the economic damage, and of course we still have Brexit to contend with, and any economic problems that causes. Now you may have heard people talk about scarring, which is the simple idea that if you damage the economy, it may not recover to where it started. So for example, if we look at unemployment, it had reached very low levels in 2020. But due to the pandemic, it's probably increased above 10%. The problem is that some workers who've lost their jobs may find it difficult to return to their previous job or find a new one, which means that unemployment remains elevated for some period of time. And you can see examples of hysteresis or scarring after the global financial crisis, where unemployment peaked above 8% in 2011. It then took 7 years to get back down to 4%. So even though this has been a short, sharp shock in economic terms, it may be that it's damaged the economy for some time to come. One of the positives is that there's been very strong policy support, both from the Bank of England, but also from the government. And this is a graphic produced by the Bank of England. The immediate impact of the pandemic is to reduce jobs and incomes, which is obviously a negative for UK house prices. Because if people are unemployed, then they couldn't be considered for having a mortgage, and they'd be unlikely to be able to buy a house. But the Bank of England is ensuring that interest rates are low, which means borrowing is cheaper, and that's a positive for the UK housing market. The Bank of England has also made certain facilities available to allow banks to expand their lending, and greater credit availability is a positive for UK house prices. And by ensuring that the economic system is safe and stable, people are more likely to go out and spend and to continue their normal economic activity. The government has also ensured that mortgage payment holidays are available to borrowers, and just under 2 million households have taken advantage of that, which is 1 in 6 of the outstanding mortgages in the UK. They've also ensured that there'll be no repossessions of houses for people who can't afford to pay their mortgage, and that will last until the end of October in 2020. The Coronavirus Job Retention Scheme means that companies can claim 80% of their employees' wages from the government for staff members who've been furloughed because of coronavirus. And this turns out to be the most popular scheme of the ones proposed by the government, with about 80% of companies making use of it. One negative factor for the UK market is affordability. A standard way to measure that is the average price of a house compared to the average disposable income of a household. So the x-axis in this graph shows when house prices are expensive on the right and when they're cheap on the left, with the expensiveness in 1970 rescaled to 100. In the decade from 2008 to 2018, you can see that house prices were very unaffordable compared to history. And if that's the case, then house price appreciation, which is the capital gain you make by buying a house and selling it 10 years later, tended to be very low. So that meant that the outlook even before this crisis occurred was fairly poor. Nationwide also publishes a house price to earnings ratio where expensive is at the top and cheap is at the bottom, with a long-run average at around 4.4 times earnings. According to that measure, UK houses remain expensive as of May 2020. If we do the same exercise for first-time buyers, with London in blue and the North in red, you can see that affordability is much lower if you live in London, although it has fallen significantly since it peaked in 2016, whereas first-time buyer affordability is much better in the North, and that remains the case. And if we do the same exercise using the nationwide data, looking at the expense of a house, where expensive is on the right and cheap is on the left, you can see that when house prices are expensive as they are now, that tends to give you lower returns over the following decade, just as we saw with the Vanguard data. If banks tighten up on credit conditions, that tends to push down house prices by making them less affordable. The Bank of England's Monetary Policy Report from May 2020 shows the availability of new mortgage products according to what percentage of the house price you can borrow. That's called the loan to value. So a loan to value of 90% means that on a £100,000 house, you could borrow £90,000. Notice how the number of products has fallen dramatically since March. The proportion with high loan to value is now much smaller. So it certainly seems as if banks are tightening up on their credit conditions, which means you'll only be able to afford a house if you can make a larger deposit and consequently have a smaller loan to value. And that'll restrict the number of people who can buy expensive houses, and it'll be a negative for house prices. If households are highly indebted, then they'll be less able to borrow, and they'll also be more likely to default on their mortgages. More houses have had to draw down their savings during this lockdown period. The household indebtedness has probably increased, and the Bank of England only expects that to fall to fairly normal values towards the end of 2021. And as time has gone on, the proportion of individuals reporting they've missed payments or had to rely more heavily on credit has been steadily increasing, although fortunately very few people have fallen behind on their mortgage payments. But that's probably down to this policy of mortgage holidays. A positive factor is low interest rates. All of the developed market central banks have slashed their interest rates. That's true of the US in blue, the UK in red, and the European Central Bank, which never increased its interest rates above zero. You can see the Bank of England slashed its bank rate from 5% just after the global financial crisis, and recently it's cut it even more to just 0.1%. And of course that's a positive if you're borrowing money, because it means you can borrow money more cheaply, and your mortgage payments will be smaller. Unfortunately, wages don't tell such a positive story. If we look at real wages, which is this line here, where we subtract the rate of inflation from the rate of earnings growth, that was starting to look quite positive in 2020, but it's now started to fall quite sharply. And it also means that the average weekly pay is now below where it was a decade ago, just before the 2008 economic downturn. And that means the amount of goods and services that we can buy with our income hasn't risen for over 12 years. And that's a negative for UK house prices, because if we're earning less, then we can borrow less. And that reduces the affordability of house prices unless they reduce. Supply and demand paints a more positive picture. This is a graph of house building by type of developer since 1923. After the Second World War, you can see that local authorities in blue were responsible for the majority of house building. But that effectively stopped in the early 1980s. Limits on public borrowing by local authorities have effectively stopped that process, which means that private enterprise is almost completely responsible for the housing supply that we have now. And in fact, there are 8 companies which are responsible for about 50% of the supply of new homes. And that's what you might call an oligopoly. It's not in their interest to increase that supply because it would decrease house prices. So the supply in the UK definitely remains constrained. But a number of factors have ensured that demand has remained fairly brisk in the UK, such as rising life expectancy, immigration, although that's likely to be lower after Brexit, rising incomes, but of course, as we've seen, those have been stagnant over the last decade. Greater mortgage availability is a positive, so as long as banks don't tighten their credit quality standards too much, that should remain a positive. And there's been a growing trend of just having one person per household. When you combine those factors, it turns out that we need about 300,000 new houses every year in England. But the net supply has been well below that. And although the government target is to meet that demand, so far it's certainly failed to do so. So that imbalance between demand and supply has certainly been very supportive for the UK housing market. And it'll probably remain so for some time to come. So let's just summarise those factors. Interest rates are effectively zero, which means that house prices are more affordable if borrowing is cheaper. Demand is likely to remain brisk for the UK housing market, and while incomes are affected by the lockdown, the policy support we've seen has been extremely helpful, both in ensuring that people carry on earning, but also allowing them to defer the mortgage payments during the tough times. Wage growth has been a structural problem in the UK for many years now, and as we've seen, real wages haven't improved for over a decade. A lack of housing supply has been supportive for prices. Low inflation ensures that we have a reasonable disposable income and makes houses more affordable, which has been a positive for house prices. But house prices as a proportion of our income remain very high, so a lack of affordable houses is still a problem. And if we do see scarring in the UK employment market, it may be some time before employment falls back to low levels that we saw at the beginning of 2020. So it's not absolutely clear-cut which way it's going to go. Some of the factors are pushing prices up and some of them are pushing prices down. But of all those factors, I think unemployment is the most important. How many people are going to keep their jobs as we come out of this furlough period? But also what happens to wages, because if you have more money, then obviously you can afford to borrow more, and that tends to push up house prices. And if we do get a recession, how long is it going to last? Hopefully not very long. If you enjoyed that video, then why not support us on Patreon? As part of our community, you can ask questions about any market you like, including the property market. And you can ask questions of other members of the community via this chat application beside me called Slack. And if you're a member of the Patreon community, we also have a friendly Sunday evening call where you ask questions and I answer them. In addition to the video replays, you get access to the notes which have links inside them so that you can research topics that interest you in more detail. So I hope to see you on one of those Sunday evening calls and as part of our Patreon community. And as always, thank you for listening.